The FDIC's favorite approach to deposit insurance reform is to expand insurance limits for certain types of accounts, such as business payment accounts. And I think that idea has a lot of merit. But one of the challenges with this option is that we would need to rigorously define the universe of accounts that would achieve increased coverage. Mr. Vito, if Congress were to take this approach, what are your thoughts on how to tailor increased coverage and what type of accounts should be included?
Thank you, Senator. I've heard several proposals for doing just that. One approach would be to expand coverage for all non-interest-bearing accounts, as these are accounts that don't earn interest and so don't serve an investment function. Other proposals include lifting transaction accounts specifically, and so, or in using the FDIC's terminology, I think they're getting at business payment accounts, which they admit doesn't have like a clear statutory definition, but one could be teased out that increases coverage for business transaction accounts. And then I've also heard proposals to predicate expanded coverage on small and medium sized enterprise employment. So something that would predicate expanded coverage on being a small business employer under a certain amount, 200 or so employees.
Mm-hmm. The goal of such an approach is to provide stability by fully securing the deposits that business rely on to function without significantly increasing moral hazard. However, if we don't carefully define the types of accounts that need increased coverage, we could see costs to the deposit insurance fund increase without commensurate stability benefits. How can we ensure that a targeted coverage increase is properly tailored? And would the FDIC need additional flexibility in order to implement that type of tailoring?
Senator, I can't speak to, I guess, FDIC authority in this matter, but I certainly agree that getting the definition right and making sure that these are distinguishable terms for the FDIC to be able to verify and enforce, and for banks to be able to communicate to customers, is the real way to enhance the financial stability objectives of deposit insurance.
Now, I'm curious and potentially worried about the effect of increasing deposit insurance would have on smaller banks. For example, under the current deposit insurance framework, businesses and individuals with more than $250,000 in deposits are encouraged to diversify their deposits across multiple banks to maximize coverage. If Congress were to increase deposit insurance, would you expect deposits to concentrate at a small number of banks?
I think that actually enhancing bank competition could require, in view of deposit insurance specifically, reform that expands coverage to allow these small and community banks to better compete against very large banks. Right now, you might have a sense of implicit universal coverage if you bank at a very large institution, because they might be the most likely to get bailed out if they fail. And small and community banks don't enjoy that same privilege. So increasing coverage for certain uninsured depositors could be a way to allow small and community banks to better compete.
Mr. Fraser, what impact would some of these proposals have on smaller banks in particular?
Yeah, smaller banks in particular. So there's a formula FDIC uses that we calculate quarterly to determine our deposit insurance premium, and that's manageable. And so the data tracking is an important consideration. How would we go about calculating it? How would we comply with a new insurance regime? And the cost of doing that is something we would have to think through. That would be one. Secondly, deposits in the aftermath of SVB, they did flow. There was a lot of slosh back and forth in and out of institutions. Some more sophisticated customers fled to the safety of T-bills, and they were able to do that via Treasury Direct. We're also seeing behavior change among corporate treasurers. They're far more active. So there were one or two notable cases at Silicon Valley Bank where everyone had their deposits in one institution, or company did, and that was a massive problem. We're seeing corporate treasurers being more active. So armed with better technology, this is the good side of it, is business owners can make good choices about where to place their large deposits. Generally speaking, for my banks, and we're $3 billion and under, we don't see too many corporate accounts or larger depositors beyond that $250,000 threshold today. So I think there'd be a minimal impact for the smallest banks, but it is a complex institution, and I think the data is not fully clear as to what it would suggest.
I appreciate that. You know, while increasing the deposit insurance may be necessary, in order to preserve financial stability. Encouraging consolidation carries its own risks. Research from the Federal Reserve indicates that the banking desert are increasingly prevalent, particularly since the pandemic. So I think we need to be mindful of actions that could further decrease diversity in the banking sector, leading to further closures and consolidations that leave families without access to banking services and further concentrate risk into large institutions. I look forward, Mr. Chairman, to working with you on these issues.
Thanks, Senator Menendez. Senator